Hi, this is Greg, and whatever you do, do not invest in stocks. Please, just promise me that. Do not invest in stocks. That is, until you learn these 5 tips that I'm going to tell you about understanding the stock market and sort of demystifying the whole subject. So if that's something you're interested in, stick around because it's coming your way. Hi, so I'm Greg. Let me tell you a little bit about myself so you understand sort of where I'm coming from. I am a former investment banker. I am also an investor, and in addition to that, I've been a full-time real estate investor. I've been studying the markets and involved with the markets literally my whole career. And throughout that process, I've probably been just as mystified as you have, in trying to understand the stock market. And so just know you're not alone. Even professionals, people that have been involved in the stock market and the markets on a professional basis, are still mystified by it from time to time. But there are really 5 basic things that you need to know about the stock market, about the markets in general, to really help demystify the whole subject, okay? And you really should know at least these 5 basic things before you venture into the stock market and do your own stock investing. Okay, so let's get into it. So the first thing that I think is really important for you to understand that most people just don't have access to, or they don't have the background in, is to understand basically what the Fed is doing and understand what the fiscal policies of the government are, and to understand how these 2 different policies can influence stock market behavior, okay? Marty Zweig, who was one of the real stock market gurus of the 1980s and 90s, he was a guy that that I follow quite closely, and a lot of people who are older will remember him. He always used to say, don't fight the Fed and don't fight the interest rate trends, okay? And if there's one thing for you to get out of this video, just remember the first thing you have to understand when you're looking at the stock market or any of the capital markets is what really is the Fed doing, and what policy stance are they taking, and to understand really basically how that is affecting the stock market. Okay, so the Fed affects the markets in 2 major ways. Okay, one is its lending rate policies, which is primarily the discount rate and the Fed funds rate. The discount rate is basically the rate at which the Fed lends money to member banks, which is basically any bank that participates in FDIC insurance and is a member of the Fed's banking system. And then the Fed funds rate is the rate at which banks basically lend to each other, right? That is more of a market-based rate, whereas the discount rate is set by the Fed itself. Okay, currently, after all this shutdown extravaganza that we've been going through and the economic fallout, the Fed recently lowered the discount rate from 2.25% down to 0.25%. So the banks are essentially able to borrow money essentially for free from the Fed. Now, what is probably most important to understand, and you can see this after the market low of March 23rd, when we hit this this shutdown that we've had from the obvious pandemic that we've had, you could see that the market low was March 23rd, and since that time period, the Fed has literally flooded the market with liquidity. Okay, so that's the monetary side of it. The other side that's important for you to understand, and we can talk about it in the context of what's going on today, is the fiscal side. That is the government spending side of the equation, okay? And you may ask yourself, like, if everything's going to hell in a handbasket, if the economy is down, if 33 million people are unemployed, and we're having massive negative growth in GDP, how can the stock market be going up? Okay, that makes like no sense, right? But what's important for you to understand is the monetary side of the equation. The Fed has been just flooding the markets with trillions of dollars of printed money, okay? And I'll explain that in a second. And then on the fiscal side, the government has been spending through the PPP program and the other various programs that they've been putting out to try to help people in this economy. They have been, on the other side, putting out trillions of dollars, okay? Now, all this money, in the fiscal sense, it finds its way into the economy. In the monetary sense, it finds its way into the markets, okay? So what do you think is going to happen when the Fed is printing money and buying securities every day and injecting that money into the money supply, right? And then by the same token, the government is spending trillions of dollars on the fiscal side. You from a supply and demand standpoint, basically there's so much money seeking a home that naturally the markets rise. Okay, so when the government's pumping money in, when the Fed is printing money and buying securities, that's called taking an accommodative position. You can feel pretty confident that they're putting at least a floor under the market. And I think you've seen that pretty dramatically since March 23rd. The market's gone up over 20%. I don't know the exact number, but it's gone up quite a bit, and most people, simply don't understand why. The thing is, you really have to watch the Fed. If the Fed is in a ridiculously accommodative position, as it is now, where it's pumping money into the system, you are generally going to be seeing a rising market, or at least you're going to be seeing a floor under the market. Okay? So Fed policy is the most important thing for you to watch. Okay, the second thing is understanding the current state of the market, which we really talked about a little bit just now. You had an economic impact. You had the government completely shut down the economy, and the government's response to it, both the Fed and the governmental side, was to pump huge amounts of money into the system, and it just has to affect the markets. The government is literally throwing everything it has at this issue, this problem, and so this is what you end up with: an up or stable market. Now, I think that when the earnings reports come out for the second quarter of this year, I think the markets are going to be surprised. And whenever the market is surprised to the downside, as I think it will be, you could see the potential for another major leg down in the stock market. Okay, but it's not going to be because the government hasn't been enormously, or the Fed hasn't been enormously accommodative. Okay. So the third thing to remember is that, and this affects mainly the idea of short-term market fluctuations, the stock market, although we like to think that it's very scientific and everybody's analyzing data and reacting completely analytically and unemotionally into deciding where stocks should trade, the efficient market theory, if you've ever heard of that. The fact is, on a short-term basis, the stock market is nothing more than a voting machine. Okay? And frequently, the stock market's wrong, and frequently, investors or traders, I shouldn't say investors, traders, short-term traders, are just reacting emotionally to news that you hear out there or other factors that may impact stock prices. So just remember that it's a voting machine. It's not necessarily rational. Don't think it's rational, because it frequently isn't. And it's just the sum total of what people think at that moment. Okay? So keep that in mind. For the fourth point that I want to make is that you have to understand short-term market movements versus long-term market movements, because those two things are affected by different factors. Okay? Short-term market fluctuations are affected by this voting machine thing that I just talked about. A bit of news comes up, a housing number, an employment number, a GDP number, any number of things that can come up that can affect an earnings report, that can affect short-term market fluctuations, okay? And I believe, and I think many folks that are, far more into this and far more experienced than I am, would tell you that it is literally impossible to predict short-term market movements. There's just too many factors that go into it. Don't even try. For most people out there, I do not recommend trying to trade stocks. I've done this many, many times in my life, and no matter how smart you are, no matter how intuitive you think you are, you may make a lot of money 1 month, but eventually, if you stay in it long enough, you're going to lose an equal amount. And it's really, in my mind, it's really a zero-sum game. The longer you're in it, the more likely you're going to give back a lot of the things that you make. So I don't recommend short-term trading. I think it's a losing game. You can, however, make a lot of money in the stock market over the long term. Okay? And since most people watching this are probably not, super experienced stock investors, it is important to understand that over the long term, meaning 3, 5, 10 years, stock prices reflect the earnings potential of the stock market or an individual stock over that time period. Okay, that is very accurate. And it is really directly related. The long-term prices are really directly related to the value that the economy and or individual companies produce over that time period as measured by earnings. Okay, so that's very important to understand. Now, just a word on that. If you're just starting out in the stock market, if you're just trying to learn, I do not recommend individual stocks for people who are doing long-term investing. Now, if you want to approach stock investing like it's something that you want to devote a lot of time to, and you really want to learn how to read a balance sheet, how to study industries, how to try to predict earnings over time, and you want to devote a really inordinate amount of time to doing that, and that's really an interest and a passion of yours, by all means. I mean, individual stocks, that's where it's at. But for most people who aren't financial people, and I assume that most of the people I'm talking to right now, you're not financial people, you have other interests, you have another business that you're in, maybe you're a doctor. For the most part, you don't want to do individual stocks, and the good news is that over the last couple of years, really over the last 20 years, there have been so many innovations that allow the individual investor to take charge of his or her investing program, and you can have exposure to the stock market, invest in the stock market, and not buy individual stocks, okay? ETFs, which have literally exploded over the last, say, 20 years, have given individual investors like us an unprecedented opportunity to invest in the stock market in various sectors. I mean, these spiders, for example, you can get literally any sector of the market and get exposure to that sector. The S&P 500, you can do index fund investing, which is, you're purely investing in the index, the S&P 500, the NASDAQ. You can go with the QQQ, which is an ETF that mirrors the NASDAQ, largely the high-tech stocks. There's all kinds of things you can do without investing in individual stocks. And guess what, guys? The smartest people, the smartest money managers, guys with MBAs from Ivy League schools, and people that invest and portfolio managers that do this for a living, most of them, 80% of them, I don't know what the current percentage is, but a very low percentage of them are actually able in these managed funds to beat the indexes. So what does that tell you? Okay, do you think that you're going to have a better track record than them? Some people do, and they can do it over a long period of time, but in general, I recommend that if you don't want stock investing to be a major part of your life, you're just trying to invest money, go with the index funds, go with the ETFs, and you'll get your stock market allocation, your stock market exposure, but you'll be doing it in a way that you're guaranteed to at least keep up with the market. Okay? Now the fifth, and also, I don't know if it's the most important, but the fifth tip or thing I wanted to tell you on this video is that one of the most important things I find, not just in stock investing, but in life, is to follow true experts, follow people that are, masters of the universe, so to speak, in the area that you're talking about. And in the area of markets and investing, there's a short list of people that I would recommend that you follow, that you listen to, and to the extent that you don't understand everything they say, then you can refer to YouTube videos such as this one, where I try to break it down into more simple terms. But just to give you a couple names, right, of people that I follow. Warren Buffett. Okay, I followed Warren Buffett for 25 years. Obviously one of the best investors probably in history. The Sage of Omaha, I'm sure many of you are familiar with him. He would be one person I would follow. Ray Dalio is another one. Bridgewater Associates founder and co-chief investment officer. He is literally the founder of one of the most successful hedge funds in the world, probably ever. And he's a true master of the universe. David Tepper is another one, a hedge fund manager who is very good with market calls. So he's one that I follow very closely. Mohamed El Erian, you see him on, he was formerly one of the top guys at PIMCO. I think he was the co-chairman of PIMCO. He's now at a different firm, but he's frequently interviewed. Great market calls, great macro and micro insights. The guy's a genius. Stanley Duckenmiller is another one that I follow. He founded the Quantum Fund with George Soros. George Soros, not one of my favorites, but Stanley Duckenmiller is one of the true market geniuses. And while it's more difficult to see him interviewed, you can see him, and there are many, many more. So there was a video that I posted a month or so back where I was talking about mentoring, and I was talking about always learn from the best. I think it's very important when it comes to trying to understand the markets and trying to understand the stock market and the bond market in particular, is to learn from the best and keep trying to go up that learning curve to get to the place where you feel more comfortable with this stuff. Okay? So anyway, that's what I have to say today. I hope you enjoyed it. If you enjoyed it, please hit the like button. I'd love you to subscribe to the channel. We talk about business and investment topics, all in the context of the digital age. So I hope you enjoy it, and please, in addition to liking and subscribing, please feel free to comment, and hope you enjoyed this, and we'll see you again next time. Okay? Bye.